Okay, folks, welcome back. This is our weekend review for November 9th, 2019. This is our dollar index daily chart. And as a reminder, this is the last time we will be using the AVA demo trader account. We'll be migrating everyone to tradingview.com. They offer a free access to commodity, Forex, everything that's out there. So it'll be a little bit easier to follow along because my charts will look exactly like yours, and there won't be any kind of ambiguity about what highs, what lows, and all those typical things that everyone has, because I've been using the MT5 demo account through AvaTrade, and because there's a lot of questions being asked about this, and I'll answer it now. There is no way for me to take the MT4 indicators that you get in month 12 that's in a zip file. They are shared on month 12's content. They don't just simply plug into MT5. So I don't have an answer for that. And it's also a reminder why I don't do anything with those indicators. Everything that I annotate my chart with or use for my commentary is all manually drawn, and there it is. Okay, so you don't need the indicators, but if you're interested in using them, once you get to month 12, you would have to use it through an MT4 account, whether it be a demo or if you ever elect to go into live trading, you would use that through MT4 only. Okay. All right, so we have our dollar index, and right away I want to draw your attention to the range, which is the low here and the high here, and equilibrium is there. Okay, there's two price points that I want you to be aware of. We had the market run completely against what my initial expectations were going into last week's weekend, when we were referring to this week's past. In other words, long story short, I had it wrong. Okay, there's no ifs, ands, or buts about it. I was just looking for a little bit more movement after this gap remained open. The previous week, I felt that we'd get a pretty significant run below this low and then eat into this range here. Didn't do it. Okay, so I got it wrong. And I got a lot of feedback from a lot of the older members and charter members and some of the newer folks. And it was actually good feedback. So I appreciate that. Like I said, I'm human. I get it wrong sometimes, and it's okay. I guess the strength in knowing what you're doing is that when you do have it wrong, you're not going to be confused about why you're wrong, and you're not going to be compelled to do things emotionally, okay, just to get something back, or to feel smart, or to smooth out the rough edges that incorrect assumption about what you feel the market's going to do causes you. Okay, and in a short way of saying it, the folks that reached out to me by way of email, number one, I appreciate that. You don't feel like you have to do that, okay, because it just adds more emails to me having to go through, and I'm not trying to dismiss your emotions about and your thoughts and your feedback, because I do welcome that, but there's a lot of you, and I just want to kind of like just throw this out there. The general consensus was this: it was nice seeing you use tools, but it not pan out, and still have a pseudo profitable weekend, because everything's demo here. So yes, I got it wrong. I had to adapt intra-week to get in sync with it, and that's what's going to be happening for you when you do this on your own. There's no hand holding, when you're not relying on ICT to give you the things to focus on. So it was good to see it happen. My goal was not to see it happen a lot, obviously, because no one likes to do that, and I certainly don't like to have an incorrect analysis. But the strengths of knowing what you're learning here is when we're wrong, or when I'm wrong, I know what I need to do: either sit on the sidelines, or if there's an opportunity for me to go against what I initially had in terms of analysis, then I'll do that. And you saw that, and we'll talk about that when we get into British pound versus US dollar. All right, so there's two things I want to bring to your attention here, and it's this fair value gap. Now remember, initially I was anticipating this staying open while price was running down the week before last, and we wanted to see if we can get into sell side liquidity. On the cash index for dollar, it did go slightly lower on this low here, but we diverged on the futures contract. Okay, and yes, there's sometimes this type of divergence occur. It can be viewed as an SMT approach to looking for divergence, but I was really committed with this run below here. I wanted to see it do that, and it didn't do it. So my initial observations was with this gap, I wanted to see it open and act as a breakaway gap, because that would constitute a more meaningful run lower, and the dollar felt inclined to prove me wrong. I mentioned if we trade through the fair value gap, we want to see it maybe come back down into this and act as real support. Okay, because now this becomes a balanced price range. You can see the individual candle going through, one single pass. Individual candle going up, one single pass. And when we drop down in lower time frames, you'll actually see that occur in between these two specific price ranges that define the fair value gap. Now, it doesn't need to come back to that. Okay, but if it does, okay, here's what I'm anticipating. If we trade down into it, that could be a run up into this fair value gap here and sweep one more time above that 98.20 level. I'm not sure why it's saying 98.19 and a half, but the level is 98.20. And it's not popping up here for me to show you. Here it is. Okay, so I'm rounding it to the 20 level for this old high. And the reason why that's there, this is what's in my mind. Okay, so the internal dialogue I'm having about dollar index is, this is an old high. We mentioned how we wanted to see it trade above that, and it did that, and it gave up the ghost. Then we spiked through it here and gave up the ghost. Spiked through it one more time deeper and gave up the ghost. One more time, didn't get higher on the futures contract. Broke down. Now we traded right back to it again on Friday. And it's interesting, it stopped right there. So if we trade back down to the fair value gap, we could see one more time run above. And if we get into this fair value gap, I think that's the last real line in the sand for the bears. If it goes through this, then chances are we're probably going to go into the 100s, 101s on dollar. Now, not right away, I don't think, but that's probably what will happen. What I'm opening myself up for in terms of flexibility is, while I do think this is a potential upside objective, I'd like to see it key off of the fair value gap in terms of a buy, because we would be below equilibrium between the high and the low. If it runs up into this area, I'm flexible in allowing that this could potentially be a new short. In other words, all these opportunities are going above 98.20. Okay, and this could be just the last one before it rolls over and then makes a run for the sell side liquidity, and there it is. The problem with that idea is there's a lot of time between now and January 31st, as we'll refer to, and I'll just flash it real quick. That's the new Brexit vote deadline. So on the 31st, they're going to vote. Hopefully they'll have a plan, but I don't believe they probably will. But I have the chart set up for cable and Eurodollar to show that very gap in terms of where we are at last Friday's close and how much time can transpire between the next Brexit vote, which will be, I believe, the next major impactful injection of volatility for Eurodollar and pound dollar. All right, so because we're so close in proximity to this level here, that could not pan out. It could just hit this and keep on going through and make a run on the buy side liquidity pool that's been sitting here for now months. So what am I getting at? What's the brass tacks in all this? We have a potential sell here, but it goes against institutional order flow on the daily. So it would be probably a day trade at best. Down here, it's a better swing trade, short term, one shot, one kill, that type of scenario. If it trades back down to the fair value gap, because we would be back down below equilibrium because we're above it now. So we would need to see it go down below that from the daily to get a high probability institutional entry drill, because it would also trade inside of the low on Friday. If we get down below that and hit the fair value gap high, that would be a very interesting area for me to want to take a long and try to aim for this fair value gap on the daily. Okay, and if we get to that price point, it'd be probably good business to take something off here and leave some on for a run above the buy side liquidity pool here. All right, so that's why that fib is there, just to give you premium to discount. And just as a visual, this is that balanced price range and the outline of the high resistance liquidity run, and you can see the benefits of seeing it like this in hindsight now. So it had a lot of resistance in here, so high resistance was true to form, even though I was looking for it to erode down into this. Because of the nature of the high resistance liquidity run being the factor that was in play on this, and you saw what happened. Basically, my trades don't pan out when I trade that way, which is again why I like to trade very, very clear, obvious low resistance liquidity runs, where we have a single V bottom or a single V top, where it's an easy run to get to that liquidity. Okay, that's like my easiest type framed setup, and it's just comfortable trading in it because I know that speed will be on my side, and it'll not hem and haw back and forth. It'll just go right to the liquidity, and there's just a really nice way of trading. It gets you in, gets you out, and it pans out relatively quickly, and it's fluid. Whereas these types of events, and also I got a lot of feedback about the contrasts, and that's what I'm aiming for, folks. I like it when the mature students that are well-rounded can see what I'm doing and why I'm doing it and the benefits of it. Because when you're really studying and you're putting time into the charts and you're annotating them and you're referring to them on a weekly basis and seeing how the price signatures are repeating, and then when I identify things as probable but not high probability, and it's a high resistance and it doesn't pan out, it makes sense. So what's happened is I've had about 24 of you reach out to me and say that, hey, look, this past week was actually one of the better learning experiences for me, because I watched, number one, the initial analysis didn't pan out, and we watched how midweek it allowed us to realign and get in sync with the higher time frame. But I understood now why certain markets are more difficult to pan out, why some setups do well for me and other setups don't do so well for me. And I can see that contrast now. And one gentleman said specifically, he goes, look, it clicked for me finally this week, where I can see where some of my trades are just like barriers, and it was very hard to hold on to them. And other trades that are real easy, they can make a distinction between the two. And that is only going to happen for you is when you do the research, the practice, the taking of the notes and studying price action, and not just simply watching my videos. You have to go in there and really compare what certain moves that you've practiced on that moved very fluidly and easily to your objectives and with very little time versus the environments that we were working within here. Now, I committed myself to trading with the mindset of going into this balanced price range and looking for the sell side liquidity pool. I did that. Now, I did that with the expectation that it could have panned out. And had it done it, okay, let's play devil's advocate for a moment. Say it went down here and ran out that, and maybe eroded all the way down here, okay? That's because that's where the other sell side liquidity pool tag that's here now was sitting over here. So just watch the previous review, and you'll see that. This is what I was kind of aiming for, but I wanted to see it run below here on the dollar daily chart. Had it done that, or if it traded down here, I would have reminded you that these are still conditions that I would have been more reluctant to trade in because of its high resistance nature. Now, it's not that I was waiting for it to be right and say, hey, look, I'm smart. I'm saying that the whole point of the last few weeks have been contrasting specific elements about price action that aren't talked about anywhere else. I mean, they're just simply not talked about. And there's a big, well, I guess it's a large vein that you can mine. Okay, the miners used to have an expression, don't marry the vein. Well, this is a vein that you can marry, okay, and dig into it deep, because it's going to unlock a lot of the things that you're going to feel that are adversarial in terms of your analysis and your trading, because it's going to highlight where your weaknesses are. Okay, for me, I'll tell you what happened for me as I was developing and when I understood all these types of things. I would get revenge mindset. Okay, whenever I had a market move go against me like this, I would be like, I'm out to get blood. Okay, like it's first blood ICT. That type of mindset would come over me, and I had to overcome that by systematically desensitizing myself, by looking at the things that worked well for me, which was the whole basis of my low resistance liquidity runs. And if it didn't have all of the signatures that I like, I won't trade them. Now, your question is going to be, well, what are those signatures? Well, it's price action model 6 and 7. Okay, so when you're charter, those are the things that I like, because it makes it very clear for me. It's very easy for me to see it. Now, I'm not saying it's going to be easy for you to trade and make millions of dollars. I'm saying it's easy for me to operate in price action with 6 and 7 as the basis of how I trade. Okay, that's like that's it. I mean, that's me. That's ICT. Okay, there's a lot of algorithmic things that go along with that further enhance it, but for the most part, that's kind of like, that's me. So when we have these high resistance liquidity run conditions, and we'll do things like this again. We're not stopping here. When the environment creates itself again, we will go in there and do the same thing again, because I knew going into this, the folks that are really putting an effort into here, and then you're probably saying, there's thousands of people in here, and you're telling me there are only a couple dozen came back. I don't know. Maybe there was more of you that sent me emails. And again, that's why I said, please don't feel the impulse to send me an email, because while I do appreciate them, it just adds more to my inbox, and it just pushes the other folks' questions that may be there. Because a lot of you just saying, hey, look, here's the heads up. I really appreciate what's been going on. And look, if you're active in the membership here, that's a thanks enough. Okay, because you're putting the effort behind my life's work. And as long as you're doing that, I'm promising you're going to get what you're here for, but you're all going to get it on a different deadline. Okay, y'all have different, thresholds in your understanding, and you have barriers. When you have these environments like this and you push yourself to trade in them and they don't pan out, that's the point, because you want to see what's going to materialize in yourself. What manifests? Okay, does a fear come over you? Does a sense of doubt come over you when you're using the concepts? Because it's easy to combat that when you understand the difference between high resistance and low resistance. Because the folks that may have looked at this past week and got discouraged, and it's probably I didn't get anybody sending me an email like this, but say you're new and you just recently came in your month 1 or maybe month 2. You don't have it under your belt how many weeks we've had where it just comes out like a script. It just pans out. Go back and listen to these last couple weeks. I've outlined that the probability for this run, even though I was committing myself to it, was low probability because of the high resistance nature. The only thing that changed the previous week was we seen this fair value gap. Okay, and I said if it stays open, that could act as a breakaway gap, and it would realize a better probability of going through this range quicker than had it filled it first and it went lower. You follow what I'm saying? So there is a context there, okay? And there's one person in this group that's highly critical, okay? And they're going to say or think to themselves, and they're probably chomping at the bit to go on Twitter or go on to the forum and kind of like make some kind of snide remark. But like every other time before, that mindset is missing the point here, okay? Obviously, I can wait and see what things pan out, and then I can take my trade. I'm not trading on Mondays, okay? I'm not doing that. And Tuesday didn't line anything up to give me a trade. So that's the benefit of having the mindset of what you're learning here. Even in a high resistance liquidity run scenario, the market has to do certain things. And if you have these binary things, if then statements, if they don't pan out, you're never really getting into a trade. Now, that's not to say that you're not going to have a losing trade, because you're going to have a losing trade. But I operated in the context that I'm going to work within this high resistance liquidity run. Because either way, whether it worked in my favor or whether it failed, like you saw me enter a trade and I took a loss on the secondary position, but it was a minor loss. And the win came by trading in sync with the directional bias on cable going lower. So again, it's not about being right or wrong. It's about finding the setups, keeping risk managed, okay? And then also for you personally, it's you need to determine what are going to be the things that cause you to flake out, because there have been and there is highly critical people in here, and they like to share what they think is going to happen to me in private or in email, and they're very like macho about this is going to happen, and it doesn't happen. And you don't hear anything more about it. And then all of a sudden I get an email or a direct message when I was accepting them, and they hate life, they're going to quit trading, and yada, yada, yada. And these are the same folks that are highly critical about things where I give statistics about how often we have things pan out. Remember, I started the week last weekend saying that I expected specific things to happen. It did not pan out, but I was able to engage. And Wednesday I told exactly what I was looking for. Cable should be a low resistance liquidity run based on getting in sync with what the market was showing me here. I had everyone in the Wednesday review focusing on this area for the fair value gap on the dollar. So that means there's going to be a draw on a higher dollar. So a higher dollar is going to allow foreign currency to go lower. And we had a low resistance liquidity run scenario in GBP USD on Wednesday going into Thursday. And then when we get to it, you'll see it. It's really easy. That's what has to happen in your mind, where you don't fester and just grow toxic over an assumption you will have, or maybe I have, or you're led to believe, and then you get so ingrained on it has to be just this way, and then when it doesn't pan out, it completely blows your mind and you're discombobulated. You're confused. You're so worried about beating yourself up or figuring out why that failed, when the opportunity is, okay, move to the sidelines or reverse your mindset, and does it give us another reason to go the opposite direction? Now, Wednesday gives us time in the week to do that. So there's a lot of give and take that's required for you internally, and it creates flexibility. If you don't have flexibility, the market's going to break you. Okay, it's simple as that. Again, just as a reminder, the last few weeks here, we were studying very intimately the effects of high resistance liquidity runs and why we do not like to trade in those environments. And I took you back to, again, month one. This is why I beat this to death, because month one, that content gives you the framework to work within and build on. And if you don't have that going forward and you rush through month one, you're not going to get what you want, okay? Or you'll have to go back through it a couple times. And another member say that it finally clicked for them too, because they went back to month one and everything that was taught in later months and in charter fell right into place. And that's what I'm referring to. You just can't watch my videos one time. They're deep. They're very dense in terms of, well, there's a lot of insight in there, and you're not going to fully appreciate the things that you're hearing the first time, because there's other lessons later on, and they're spread out through all the entire mentorship, and lessons that, like when I talk about certain things in the commentaries on Wednesday and on the weekend, like now, I'll say something or I'll refer to something, and then it'll be like, that's it. That's that final piece that you didn't really know what to ask for. And I certainly ain't going to know what it is, because you're all going to be in different levels of your understanding and development. But I'm only teaching on what the market's giving me at the moment. And because we're watching it live before it pans out in the charts, it gives you a more intimate relationship with price. Whereas if I said something in hindsight and said, okay, look at this, right away you're thinking to yourself, okay, this has only happened because it happened in the past. But when we talk about things going forward, okay, it's more meaningful. It's more impactful to your number one. It's holding your attention because now you have a vested interest in it, because you're equating your ability to see it pan out, or my ability to call it before it pans out. And does it have continuity? Does it have consistency? Does it provide a tradable framework, which is the basis of why you're learning how to do this? We're studying intimate signatures and price actions, so that way you'll see that reoccurring thing that you want to trade on. And notice I'm not sitting down giving you a cookie cutter approach. I'm only talking about institutional order flow on a daily chart. And that basis opens up a myriad of different setups that you learn throughout the core content. In various months, there are certain things that are highlighted specifically, and we focus specifically on certain elements of a market. But when you have a collective understanding, a well-rounded understanding of all of it at charter level, and you go through the price action models all the way through 12, then if you go back to month 1, it really makes it click, because you have forgotten, trust me, you have forgotten what I have hammered on everyone when they go into month 1. So anyway, that's just as a reminder, folks. If you haven't revisited the month 1 content, do it. Okay, you want to kind of cycle through it, and once you're charter member, and say we go through all the trading plans in 2020 for each one of those individual price action models, you still should go back through all the core content again, and you need to cycle through it and do it for a couple years. Okay. And that's what I'm saying. Like, it's going to take you a long time to see the things. Because I have memories and experiences that really solidify these concepts to me. Whereas you may listen to something like a rejection block. And then some of you think, well, I'm not worried about a rejection block. But when we get into other topics, rejection blocks will be much more meaningful to you. But we've already talked about them. But suddenly something's going to happen later down the road, and you're like, man, these things, I really have a lot of affinity for that now, because, you taught something new about it. No, I taught them already. You just aren't working with them, and you're not studying them to see the validity behind it. So again, it's like that with every one of these PD arrays. And once you grow accustomed to one you'll gravitate to, okay? One you will feel more, I guess, drawn to. It's a matter of seeing something that is easy for you to spot in the charts. It makes sense to you. You don't have to feel like you're forcing something. It's either there or it's not. And when it leaps off the chart at you and you feel comfortable taking it, that's a testimony, number one, you've seen lots of it in terms of sample size, and you'll trust it. Now, include high resistance liquidity runs in that scenario, and it diminishes. Okay, this is the importance, and I'm going to continue with the commentary. All of the things that I teach throughout the core content, okay, and that's why there's people in these chat rooms that are taking copies of Saeed's videos, okay, and they all think they're smart. They think they're beating the system here. They have no idea what they're doing, and they think everything in terms of a down close candle is a bullish order block, every up candle is a bearish order block, and every higher high V top is a breaker. They're not. Okay, there's things that I haven't even taught on yet, and that's why they're frustrated. Sometimes they'll get it right, but that's just like retail. Sometimes they get it right. Most of the time they're wrong. So just trust the fact that when we have high resistance liquidity run conditions, okay, that is low probability. Probable is likely, but not highly probable. So are you going to put live money at risk, be able to sleep at night, trust that you're in the move and you're on side, not off side with institutional order flow, and not feel the compulsive need to go and look at your chart and your account every 5 minutes? Because that's what will happen when you're in high resistance liquidity runs. The chances of you panning out are not high, so they're very likely not going to pan out. And if it does pan out, it's going to test your patience like you've never had it before. And it's going to manifest things in your mind and in your behavior. Your demeanor is going to change. You're going to be irritable. Why? Because it's taking longer than you want it to. Now, all of you think I'm a very patient person. I am not. I'm a very impatient person. I want my money now. I want to get in the move. I don't want to have any heat on it, and I want to see it run right away. I want to see speed and magnitude, distance. I want to see it move. That's what I'm looking for. If I don't see that, I'm already thinking trim some of the position. That's going to trim some of the risk. If it doesn't move by a specific time, that's a time stop. I want to see it move by a certain time. These are all algorithmic. You'll learn these things in 2020. But the point is, charter members, not the people that are less than charter member. The things that you need to understand is that the PD arrays are high probability when we are in low resistance conditions that are defined in month 1. Now, that's just the foundation. We go into greater detail throughout the core content and charter, price action models, all that, in greater detail what makes a low resistance liquidity run, okay? But these conditions have been really beneficial to you, even though you don't fully appreciate it. Like I said, I'm very appreciative of the folks that reach out to me, because this is a hard lesson. It's not an easy lesson. And I could have made a whole course about just this. And 99.9% of the folks that would be in it would feel like it was a waste of time, only because they want profit for time exchange. They want immediate understanding, go in, make profits for a monthly payment. Not understanding the greater importance is identifying these conditions in the marketplace, so therefore you don't mess with them, and therefore you don't get frustrated, you don't get stressed out and lose money. That's what this has been about, in case you missed it. Okay, newsflash. If you can identify these moments or periods in the marketplace, even though markets are always constantly moving, you're going to encounter the hardest opposition, even with my concepts, in this environment. That's what makes being in this mentorship beneficial, because I'm outlining and explaining to you why it's going to be hard. You don't get that from other people because they don't really understand it. They'll give you every scenario why the indicator should tell you the price is going to go up and down, but they don't understand price itself, and they don't understand market profiling. And notice when I say market profiling, I'm not talking about those horizontal volume bars over here. Okay, I'm not talking about that type of volume profile. I'm talking about market profile. What type of profile is the market in? Consolidation, expansion, retracement, and now, as we've learned, high resistance and low resistance. Low resistance you learn at month 1, but we now have certain measure of experience that we can relate to when I say, okay, we're in high resistance liquidity conditions. All right, right away, that paradigm shift should take place. Okay, if I am feeling antsy or I'm really gung-ho about taking trades, I need to dial that back considerably, because we're in an environment that is going to provide a greater deal of opposition. So I'm arm wrestling the market now. And who usually wins? Yeah, trust me, I've lost fortunes, okay, learning what the last few weeks you have had the benefit just for $155. And for the people that are charter members, it didn't cost you anything because you've already paid. So it's important that you know what we're doing here. We're not twiddling our thumbs. I'm not wasting your time. In case if you think I'm wasting your time, I have not received any kind of feedback like that. But I know invariably some of you are going to feel like, okay, this feels awkward. The market isn't. But you got to go back and look at last Wednesday's video, because we don't stay offside. The market's going to give us indications, okay? You're going to have a losing trade. You're going to have losing analysis. You're going to have things not pan out like you want. It's not going to move when you want, okay? It'll mess up initially, and then later on it'll do something else, and then take you right back into the analysis that was initially wrong. And now it gets in sync and does certain things that'll say, okay, now I was wrong. I was premature about my assumptions of what the market's going to do. It went against me a few days or a week or two, and then it does something entirely new, and it puts you right back in that same frame of mind. It's not chasing price. You're aligning yourself with price. So, like I said, you have to be flexible, because if you're 100% rigid and you're not allowing yourself to listen to what price is telling us, because you're not going to get the highs and lows, okay? You're not going to do it. Forget about it. No one's doing it. I don't do it, okay? If I push it hard enough, eventually I'll have losing streaks. I will. And because I know that's likely, I want to work within an environment that has the easiest probability for me to see it move quickly so I can get in, get out, and be profitable and done. I hate being wrong. I hate it because I'm obsessively compulsive. It's not because I'm greedy. It's not because of anything trade-wise. I'm like that with everything. It's not just trading. So I had to build very specific rules and identifications to classify certain conditions that eventually lead to problematic trading conditions for me using these concepts. So that's what we've done here the last few weeks. I fleshed out an idea. We mentioned how this is a high resistance price range. And while it could still go through here, it was not high probability. And you saw the effects of that. We went the other direction. So anyway, I'm being a dead horse now. I just want to make sure that the folks that are maybe considering that, they didn't get the message, they didn't get the lesson in it all, okay? Because that's what we do here. I stand on the center of the stage and I let it all hang out. So either I'm right or I'm wrong. And if I'm wrong, I have no problem with that. I have no fear of being wrong. Zero. Because one transaction or even a string of transactions aren't going to sink this ship. I know where I'm going. I know what I'm looking for. And I may get my bearings off once in a while. But it's beneficial because you can see how, yes, initially, my analysis going into this new week, this past, was one way. And then come Wednesday, I was like, okay, well, this is telling me something different. So I have to go in and I have to compensate for that and get in line with what it's showing me. And what did I do? Did I jump on a high resistance liquidity run? No. I went right to GBP USD that offered what? The low resistance liquidity run, running the double bottoms. Okay, so anyway, this is where we're at on the daily. I think this is where we're going to go next. I would like to see it trade down into the top of the fair value gap here, and that would be this low at 97.89. We'll just call it 97.90. So if it trades in 97.90, I'd like to see it react there, and that would also be an institutional entry if we get below this this candle's low here, which it probably isn't going to let me show it because it's overlapping with that horizontal line. We'll just get a rough idea what that close here because its close is a little bit higher. So 97.95, and it goes just below that. So it's before you get to 90. So probably 91, 92, something like that. Friday's low. And then we'll look for it to trade in here. Anything through this takes us right into the buy side liquidity pool on dollar. If we drop down into an hourly chart, you can see we have a BISI here, buy side imbalance, sell side inefficiency, that overlaps also with its consequent encroachment almost right at the top of that gap. So 97.88. So that we have a relative equal lows in here. It's a lot of things pooling and concentrating around this area here. So if we get any kind of retracement down here, sweep under here, close in this BISI, the fair value gap, and then trade back to the fair value gap, which would be natural support on a daily chart, that would be a really nice run. Okay, and also might be an optimal trade entry from the low here to the high. We also have a really high probability because we have the sell side liquidity pool before it trades down the optimal trade entry, and then look to see it trade higher. And I'm going to drop into a 15-minute time frame because there's something I'm going to bring up because it'll be important when we go to the cable market. All right, so these lows here on Thursday, just be mindful that we made lower lows here, okay? I had a question by one of the members relating to SMT, Smart Money Tool or Smart Money Technique, where we look for divergence between correlated pairs or correlated markets or inverted or inversely correlated markets like the dollar versus the cable. Dollar made lower lows here, okay? This in here is optimal trade entry, sweeping below a sell stop liquidity pool, bullish order block, runs higher through the fair value gap, okay, on Thursday. In here, I'll come back to the dollar when we get to cable and refer back to the SMT question that I received. Okay, and then here's euro dollar. Euro, we had the previous high here didn't even come close to it. I mean, it got, well, I guess it did come close to it, but it didn't go through it. I was expecting it to just at least spike through it, and didn't do that. Really heavy, went lower. We had a fair value gap in here. Again, I have this date on the chart. I'm not going to keep it like this, but I just want to show it. Have that on your own chart also, so it reminds you how much time there is before there's really any kind of impulse behind price because of the Brexit. So Eurodollar and cable are going to be highly linked to any kind of Brexit news. It's going to be more specific to pound dollar because they're trying to get themselves out, or maybe they're not trying to get themselves out of the European Union. I hope they do, but some of you probably don't like that idea that live over there. But let me zoom in here a little bit. All right, so we have the equal highs in here. Closing the fair value gap, and as I mentioned on Wednesday, I wasn't sure if we trade through that and go heavier. It did, and Friday we had a really nice sell-off day. Anything below us, the wick I'm not worried about in here. I like the order block. We didn't get down into the body on this. We just got into the wicks in here and closed the fair value gap there. If we come back down, bang into the open on this candle at 109.82, that would be a level I would expect some kind of reaction. I'm not saying it's going to go there and go straight to the moon. I'm saying that we could get some kind of a trade here, maybe some kind of a day trade or something like that. Otherwise, if we lose the order block, okay, we have these old lows here. If we trade through this with speed, now this is really important, listen to this now. If we go through the order block and then we trade through this level with speed, that low is not the low of the year, and I would be wrong, okay? And admittedly, now looking at it with the January 31st, I've done some work in researching some more information about what they want to do, what they may have in terms of a plan or may not have it in terms of a plan. I was reading a lot of reports about Brexit and all that, and I don't claim to be any smarter. Okay, trust me, it's confusing. So this is all new, like I've mentioned many times before. There's never been a Brexit type environment. So anyone that's saying they know exactly what's going on, I've said this multiple times, they're full of crap, because this is so complex and so many things and factors involved. To me, it's a dream come true for the central banks of England. Okay, because they can whip their currency around all the time on this stuff and just clean up. And the problem is that is going to be a problem for their currency if and when we ever come to some conclusion about the Brexit. Whether it's going to happen or it's not going to happen, it's going to create a lot of mess that it will take time to get through all that and then return back to a normal state. So this could potentially lead to me not wanting to touch GBP for a long time when they ever come to some final decision, because there may be a lot of noise in that pair that forces me to trade another pair instead. Okay, so I just put that out there because that's my concern as a trader. I mean, I've focused on this currency pair for decades, and I don't want to fool myself into thinking that this is the pair I should only be focusing on, because the Brexit or non-Brexit event, once it comes to conclusion, if it ever does, that may be problematic for me for this pair. So I have to be aware of that and change. And what kind of changes would I have? I would trade something else with the dollar. It could be the Aussie dollar, it could be the New Zealand dollar, but I have to be with the dollar somehow, because in the United States you get tax treatment for trading Forex if you're with the dollar pair. I don't know what your tax code is. If you're outside the States, you may not have that type of restriction for trader status, or you may not even have trader status in your country. I don't know. I don't claim to know taxes. I just know that in the United States, this is what we have to do here. But if Brexit becomes an issue for GBP, it's going to be linked to Eurodollar too, and that may create a quagmire for the pairs that I like in Forex. So what would that mean for me? I would, like I said, trade other dollar pairs and no more than two, and then also potentially bring back in index futures like S&P futures and or bond futures. And like I said, I'm not worried because the things that you're learning, they work in other markets. And it just helps me as a person with obsessive compulsive disorder and focusing, on one or two things at most. Because otherwise I'm like a dog in a meat market. I'm chasing all kinds of things if I have a lot of things in front of me. And I just can't excel doing that. I'm going to do one thing well. And if I focus on one or two pairs, one of them is going to speak to me. And it may not be the best move between the two, but I'll get something. And that's all I care about. So if we get a run back up into this red line here, that would be an immediate rebalance. If we open and trade lower and close on Monday and not close that in, then this becomes a deferred rebalance or standard fair value gap. Okay. If we trade through that and higher, okay, we have potentially a run up into this area here. That would be another area where we could punch up there and then roll over and go lower if the dollar is going to go higher. So if the dollar is in fact going to run its equal highs on its daily chart, it could roll up in here. If we get some kind of consolidation, we could see it trade here and then send it lower with a run higher through those daily highs on the dollar index. Otherwise, I'm not interested in this one up here. I think this is going to be enough. Bullish order block, like I said, something tradable here could happen, but if it goes right on through that like a knife through butter, or specifically a hot knife through butter, then we're looking at these old lows back here, which also is an overlap of the mean threshold of this down close candle, which is a bullish order block. Okay, and why is it a bullish order block? We had a fair value gap that has since been traded twice, but now the mean threshold becomes the level, which would be just below here. So it could spike down through here. But if we see a lot of speed through the order block, forget this low. It'll get dusted. Okay, it'll just get smoked really easy. And we'll probably go back to looking at that weekly chart, which I'll pop up here now. We ain't talked about this in a long time. Zoom out. And the volume imbalance that exists over here. Okay, so it takes us down to the 107s or so. What is that? High. Yeah, 107.80 we'll call. All right, so if we get below this low here, 107.80 is our objective on a long term, and that means like 101 potentially on $1, or maybe a little bit less. And then let's go into hourly for euro. Now here's another thing, just like we had these equal highs here. Again, same thing here. And I don't like this, to be honest with you. I hate when it does this. My preferred setup is if I'm going to get something like a deep retracement, let it stop here. I don't like these really high ones because as soon as we get above what would be normally an optimal trade entry, I'm demanding that this high gets taken out. And if I don't get this high taken out with a spike above that and sell as a external range liquidity, turtle soup sell basically, if we don't get that, or if I don't get that, then I miss that trade. I miss this move. And that's okay. But to me, if I were honest to sit down, it's like say we're sitting at a restaurant, okay, or if I was a drinker and we were sitting at a bar, which I don't drink, and we were just talking trader talk. Okay, what's the thing I hate most? I hate this. Okay, I hate this. I hate when the markets do these types of things because if it goes back up to here, that's normal optimal trade entry, and I expect that. And I could take a trade here and make a run here. The problem is if we get a deep retracement, yes, if you sold your optimal trade entry, would your stop be hit? Probably not, because your stop has to be above it. Okay, but I prefer to take trades above old highs and sell there, and below old lows and buy below old lows. So these type of scenarios where they're almost identical, I hate those setups. I hate that in price action because in my mind, this is at some point in the future, and I don't know when, this one and this one, they'll have their day of reckoning, okay? And I don't trust them because this is where all that retail theory that hurt me in my developing years, where I would see these things as resistance and I would sell them. And in this case, they work. In this case, it worked here. But every single time I put live money on those types of events, they always ran through and stabbed me and stopped me out. So I have a very deep-rooted disdain for these things. I hate it. So I'd prefer it rather than run up through here and then sink it. And it makes perfect sense to me. And on other brokers' feed, maybe this did go higher than here. Okay, I'm quite certain it probably did on somebody. But when we have these events here, I don't like that setup. Which is, again, why we talked about cable. And I was unwilling to really make a case for Eurodollar. If you contrast what I was saying about between the two, I was more clear about pound versus the euro. All right, so here's Thursday, the day after we did our Wednesday review. Price did rally up, didn't take that out, and eventually sold off, came back up in here. Fair value gap, consequent encroachment right here, and fades and sells off. Now it creates this imbalance. Now I want to talk about this also because I got a member ask me about fair value gaps, imbalances, and how the daily chart or higher time frame charts are very clear about having a single candle like this here. They can see that in the daily chart, but if they zoom in into this area here on a lower time frame, it'll look like this, where it doesn't look like there's any kind of fair value gap at all because it looks like it's back and forth, back and forth, back and forth. This is an hourly chart. If you're comparing one single pass that creates or constitutes a fair value gap or an imbalance on a daily chart, the rebalancing on that time frame, okay, and I don't want to sound like I'm specific about time frame because the algorithm isn't focusing primarily on a one time frame over another, but just know that the higher time frame daily, and let me go back to a daily chart just to really explain this. This whole price action below that little line segment here, all this movement here, it doesn't look like it has any imbalance at all because it's been back and forth as it went lower. If we look at it on the daily, it's just one single candle below that red line. Okay, so what I'm doing is I'm forecasting if we have another candle on Monday and we don't come back up to this line here and rebalance this candle's low on the 7th of November, if it doesn't come back up here on Monday, then we expect it to happen maybe potentially on Tuesday or Wednesday or Thursday and then resume going lower. Right now it has one single candle. If it opens Monday and doesn't fill that in, this one single candle between here and whatever Monday's high is going to be, assuming Monday's high is lower than this candle's low here, that would give us a fair value gap, which would be a deferred rebalancing if it goes back up to this line here. If it goes on Monday, trades right back up to that right away, that's an immediate rebalance. So what am I saying? I'm going to have an interest in selling short here if we run on that on Monday. Now, I'm going into it with a mindset that it would be rebalanced to here and then run for the order block. That's what I'm anticipating. It may not give it to me on Monday. It may be a deferred rebalance, or it may not even come back up there at all and just stay heavy. So you're left with those three options, or at least that's what I'm left with. And you have to wait to see which one it gives you. And it may give you an opportunity to just simply watch price run without you. And that's what happens sometimes. I mean, it is what it is. So that's what I got for Eurodollar. All right, so here's cable. And again, Brexit vote January 31st is noted here. Let me take these daily dividers off so it makes it a little bit cleaner. I have the range here from the low up to the high. Equilibrium is here. That takes us right inside this fair value gap. Even if you notice, if I use the low here also, below equilibrium, it still takes us to this fair value gap. So at or below is our minimum when we look for a buy. And if we're looking for a draw on liquidity, same thing. Okay, if we're lower prices are expected, it certainly looks like it's heavy here. There's really no reason between now and January 31st to anticipate this type of price movement. It's just, I think it's starting to wilt, and all the expectations and hopes and aspirations around Brexit, I think, has already been priced in here with this drive, and now we're moving lower. So while all this initially was rebalanced on the daily chart, there's really no imbalance on the daily. Lower time frames, you can find all kinds of smaller little fair value gaps and imbalances, but from the daily perspective, at equilibrium or less, everything on this low or this low to the high sends us right to here. So my focus is right there on that fair value gap on the daily. So that's the only reason why I had that on there. So this is what I'm anticipating price to reach back down into before January 31st. And if we get in here, that might give us something that's tradable as well to the upside, but I'm not expecting anything wildly bullish. Now, if we do all kinds of hokey price action and moving back and forth, and then we trade down into the fair value gap at this or very close to this time, then it might be very impactful for the upside, okay? But between now and January 31st, I'm looking for price to pull into this area, okay, drop down into that. And it's simply because of the things I read on Brexit, and I might be wrong. And like I said, if I'm wrong, I'm wrong. I don't have any experience on this. So I'm gaining whatever experience, whether it be paid to me in positive dividend or negative withdrawal in terms of what I get from executing on this. So just be mindful of that. Anything I got with Brexit, I don't have any experience inside the or anything with the British pound between now and January 31st. If I'm right, I'm not weighing a whole lot on that. It's just new experience. If I'm wrong, I'm not beating myself up about it because like I said, I'm engaging in an environment that it's new to me. So all of this price action here doesn't make any sense to me to have to rebalance until we get down to here. Okay, so top of the fair value gap, we're looking at that at 25.15, 25.20. So it gives us about 250 pips, or 200, what's that? 200 and, yeah, about 250 pips, we'll call it, from where we got on Friday's close. If we drop down into an hourly chart for cable, all right, here is our market maker sell model, which was the basis of me telling you that we were going to look for a sell on Thursday with daily dividers on. So here's Monday, Tuesday, Wednesday, Thursday's trading. We had a fair value gap in here. Price runs back up to the bearish order block, which you'll see when we get down to a 15-minute time frame. The draw was the equal lows here, and then the low over here. So here's our consolidation, run, back to the consolidation, accumulation, reaccumulation, reaccumulation, smart money reversal, low risk sell, distribution, 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 and run below the equal lows on Thursday, and a continuation on Friday rolling over. If we look at the 15-minute time frame, here's our bearish order block in here. And if you don't like that, you can use the breaker, which is here. Okay, draw that out in time. We hit it. I'm highlighting the bearish order block here, and also this is SMT. Okay, I got a question from a member because you don't hear me talk a lot about it now because it's something that I taught already, multiple things about it, and I don't feel like I need to do it all the time. But the only time that you're really, or I'm interested in using correlated pair SMT or dollar-based SMT or any kind of divergence study, when we look at related or anytime we look at inversely correlated pairs, like dollar would be inverse between the pound dollar and then the dollar index itself. And what do I mean by that? All right, from this candle here, okay, so 10 to 11, which would be here. So 11 is lower than 10. Okay, in terms of the time. So cable was unwilling to make a higher high or equal high. From this high here, it went lower, kept making lower highs after it hit the order block. Now let's go back to the dollar index. The dollar index at 10 made a low at 97.66.5, only to make a lower low later on at 10.45 at 97.63.5. You see that? And then in this candle here, same thing, 97.63.5. So we went lower for one more hour after we traded down below sell side liquidity, optimal trade entry, breaker, here's a low, high, lower low, find the high in the middle, last out close candle, Draw that out, and there's your breaker. Going over to cable, the SMT divergence is here only because, now listen, this is important. SMT divergence should only be considered when there are stops being ran or after we return back to fair value. Okay? In that period, like we're trading into a specific range, if there's heavy distribution, you're going to see it because it was unable to make that higher high, whereas it should have made a higher high because the dollar index made lower lows. It's completely inverted. Everything we see in the dollar should be a mirror image of what we expect to see in our foreign currency pairs. So I gave you on Wednesday a short for GBP USD. The setup is here with optimal trade entry. Watch what happens when we have the Fibonacci put on. It meets all of our criteria. So here's our high. Again, we're using the wick high because we're doing range, not, in other words, we're looking at premium to discount. So here's equilibrium. It has to trade up to or preferably above that, and it does. So we're in a premium market, back to a bearish order block, market protraction or Judas swing, and then we start seeing failed higher highs when the dollar was making lower lows. You see that? Let me zoom in a little bit more. See, we're making lower lows here. Okay, the candle here at 11 and the candle here at 10. Lower. Cable, zoom in. The high's 10. Here's 11, lower. It should have made a higher high. It didn't. So we were in heavy distribution at a bearish order block, so we know that the premium array that was traded to here above the buy side liquidity pool, above these highs, all of this is a Judas swing, and then that's where you're looking for the SMT divergence. If you're looking for SMT divergence, anything outside of a fair value gap being traded back to, in other words, any kind of imbalance, okay, any kind of imbalance, or running above an old high, okay, that's running on buy side liquidity. If you see that and sell side liquidity is not ran out on an inverted market like the dollar here, if you don't see that, then that's an SMT divergence. So you're not just simply looking for every single candle versus another candle. There has to be a context behind it, because what SMT is really doing is it's raising a red flag saying, look, all of this looks like it's, when it's a bullish candle, it looks bullish. It looks like a bull flag, but it's heavy distribution. It went up there to reprice at a premium so they could sell at a premium and let the retail buy it at a premium. And then they reprice aggressively lower below the equal lows. Okay, so that was what we were outlining and anticipating for a run for Thursday into these relative equal lows, and then ultimately these equal lows, and then this low here, and which would take us out to here. And that's that setup for Thursday, and the answer to the SMT question I got. Last bit of business is gold. Gold has a fair value gap in here. Let me zoom in a little too far out. So a fair value gap in here that looks like it'll probably close up this week. It would take us down into equilibrium below this fair value gap. So here's equilibrium. So at equilibrium, what do we have? We don't have anything except for a down closed candle, which is a bullish order block. So be mindful around that 1430 level. 1430 could give us a little bit of a pop on the upside. Again, I'm not trying to call a run to the moon, but below equilibrium we have equal lows here. So we have a discount array there at 1405. So 1405, 14 big figure, and then if it has any further downside slippage, we got the BISI here, buy side imbalance, sell side inefficiency, that would rebalance completely at a low of 1341. And if we are going to see dollar run out its daily equal highs, then you want to be focusing here on gold. Okay. Also, think about it like this: we have equilibrium and an original consolidation, rally, back to consolidation, accumulation, reaccumulation, smart money reversal, low risk sell, distribution. Somewhere in here, there should be another sell form to take us down into this fair value gap, if this in fact is a market maker sell model. And if we get a run below here, anything that rallies up back into that 1340, 1345 level, which is in here, would potentially make a run for the equal lows here. And again, that's assuming a whole lot, because this is a daily chart, and it would take a lot of bullishness on the dollar to do what I just said. And I don't know if that's going to be there yet, but I got a request for my views on gold. This is what I got. And obviously, we have to see a lot of things take place in the dollar index for any of this to really transpire. And that, my friends, is going to be it. This is, like I said, the last time I'll be using the demo account. We're going to be migrating over to tradingview.com on Wednesday. And any of my charts that I share on the forum will be in the forum and context delivered by way of TradingView. On Wednesday's review, I will give you all of the choices that when I pull up my charts, what I'm pulling it from and what symbols they are, all that stuff. So don't send me any emails over the weekend. Hey, what should I use? What dollar index? All that stuff's going to be given to you. So Wednesday's video will probably be a long one, probably longer than this one, but it's going to have a lot of things in there to hopefully head off any kind of questions you may have right now or get as soon as we start using TradingView. I am not a proficient user of TradingView. I don't think you need to be. I don't know all of its tricks and little things and shortcuts, but I'm sure some of you all will probably find a way of making me aware of what they are, which I appreciate that. But I think we'll have a better learning experience using that medium, because it makes it easier for all of us to have access to bond yields, the bond market, commodities, stocks. I want to get into that, okay? And I have so many of you now, and I get so many questions that you don't realize I'm answering. Like, I've answered about 60 different questions that I've received by email in this teaching today, in this discussion, in this review. And you may not have felt like I've given you much at all because you didn't have these questions or you didn't have these concerns. But there's a lot of you, and I have to do my best to make sure I fill in the gaps when it's applicable. Some of you are asking questions, obviously, in email that were answered in later lessons, and you get that in a response from me. But like I said, in TradingView, we'll have more resources in terms of markets to work within. So if the pairs don't really line up for us between now and January 31st, there's no excuse for me not to be able to show you something in other pairs and other markets, okay? And until I talk to you on Wednesday in video, have yourself a very pleasant weekend. Be safe, and I will catch up with you by way of the markets through the post on Monday if there's anything of importance that I need to share with you. Take care.